If you're a high income earner who's been looking into Roth conversions, but is concerned about the massive tax bill that could come with converting your traditional retirement accounts, I'm about to show you a strategy that could potentially let you do those conversions with little to no additional tax burden. Most people think Roth conversions are simple. You convert your traditional IRA or 401k to a Roth, you pay taxes on the conversion, and you're done. But that approach could potentially be leaving a lot of money on the table. My name is Samuel Harnisch, and I'm the founder of Quantitative Financial Strategies, where we specialize in tax-aware investing for high net worth families. And today I'm going to walk you through what I call the super duper mega tax-free Roth conversion, a sophisticated approach that pairs your conversions with specific investment strategies that can reduce or potentially even eliminate the taxes on Roth conversions. This is the same strategy we use with our clients who are converting 6- and 7-figure retirement account balances into Roth IRAs. And if you're serious about optimizing your retirement tax strategy, this could completely change how you think about Roth conversions. So before we get into the specifics, let's talk about why traditional Roth conversion advice can fall short for high net worth individuals. For really wealthy people, you cannot have large retirement accounts. They cause huge problems for you. And the reason for that is you are creating deferred ordinary income tax liabilities for yourself and for your heirs when you build up large amounts in 401ks and IRAs. Now, they're still a perfectly valid tax planning tool, and I use them for all of my clients, but they are a temporary solution to people with large amounts of earned income during working years. We never make contributions to retirement accounts with the intent of always keeping that money in that account. We're only doing that because we know we can get it into a Roth IRA later on. So if you have a $2 million IRA, what that is $2 million of income that you have made but not yet recognized for income tax purposes. So if you were in California and you took all that $2 million in 1 year, you'd lose about half of it and be left with $1 million. And you might say, that's silly. Why would someone take it out all at once? And you're right. But even if you had to take it out over a series of years, you're going to be losing a decent chunk of it every single year to income taxes. And it's not an option to simply just leave it in that account and never take money out. The government doesn't let you do that. The government wants to get its taxes. So what they do is in your 70s, they're going to start forcing you to take distributions from it. And every year, the percent of your account that you're forced to withdraw goes up. And that's not good for a number of reasons, but the biggest one is you lose complete control over the amount and timing of when you're recognizing income. So we want to take back control of that. Tax planning is all about having control over the amount and timing of when we're recognizing taxable income or gains. And a key piece that I think a lot of people miss is when we're talking about multi-generational wealth, we're not even looking at an individual's IRA. We're looking at their IRA in the context of their usually kids and grandkids. So let's use that $2 million IRA scenario once again. If you were to pass away and you pass that $2 million IRA to, let's say you just had one kid to make it simple, that's not actually like passing $2 million. The current rules are that your heirs, the inheritor of the IRA, if it's not your spouse, has 10 years that they have to get all of the money out of the IRA. They don't have a choice. So they could take it all in the first year. They could take the entire account's balance in the last year. Or normally what you do is you split it up over the 10 years and get the money out. But all of that is going to be recognized as income to your kid, which it kind of depends where they're at in life. But let's say they are in their high income years. Well, it's almost certain that they're going to be realizing additional income from your IRA that you passed to them at the highest marginal tax brackets. And so all this work you did building up $2 million in an IRA and you pass it to your kids, it might end up being more like they only get $1 million of it after taxes. So if you actually want to get the most out of your hard-earned money, not just for yourself, but even for your heirs when you're passing on your assets, you have to be smart about how you do it because taxes can destroy wealth very quickly. So when we look at your wealth across generations, we need to use IRAs, 401ks, and cash balance plans for what they're best at, which is deferring income when you're in your highest earning years. But then we need to realize it and get it into a Roth at some point in the future so that we avoid those problems that I was just discussing. The breakthrough that that has completely changed what's possible in terms of tax planning are these tax-aware hedge funds. And what they do is they're able to realize ordinary losses, which are different than capital losses. So if you're familiar with tax loss harvesting, where you sell a position that's lost value and swap it for a very similar one, that's great, but those are just capital losses. So those can only be used to offset capital gains. What these hedge funds do is something somewhat similar, but the result is that you get a loss that can be used against ordinary income. So if it's while you're still working, it can be your W-2 income, your 1099 income, it can be interest income from your portfolio, or what we're talking about in this video is the income that is recognized when you do a Roth conversion, because that's all an IRA is. It is deferred ordinary income that when you do the conversion, you're just recognizing it. So if I have that $2 million IRA, like in the example we've been using, over here I have a $0 Roth IRA balance. I just open a new Roth, and then here is your brokerage account. Let's say I invest in one of these tax-aware hedge funds and it passes a $500,000 ordinary loss. Assuming I had no other income, now is the time I would recognize at least $500,000 in income by taking $500,000 from this IRA and converting it over into my Roth. So now I've got 1.5 million in an IRA, I've got $500,000 in a Roth, and that conversion was shielded from taxes because of this deduction that the tax-aware hedge fund was able to realize. And so what you have is your brokerage account becomes this source of investing in a way that makes deductions to offset the different pieces of your financial plan. And basically you want to keep spitting out deductions and pressing the cost basis down, down, down in your brokerage account, because just like with the IRA, that was deferred income that you haven't realized yet, we want to store those tax liabilities that we keep deferring. We're going to store them in your brokerage account with all of these investments that pass deductions and offsets that you can use. They get stored in the brokerage account as an unrealized gain in the form of a lower cost basis on the investments. And the reason why you want to do that is because that sort of tax liability is the most efficient. It is perfect. It is beautiful to pass that on to heirs. And the reason for that is because the current law allows for a step up in basis on all investment assets in taxable accounts when you pass them to your heirs. So if I had a $2 million IRA, let's just forget investment growth just to make it simple. Let's say over the course of 4 years, I'm creating a $500,000 deduction from the tax-aware hedge fund, and every year I go 500,000. The next year I go 500,000 for years 3 and 4, and now this IRA is empty. It's zero. I have my taxable brokerage account still going, and now I have $2 million in a Roth IRA. Once it's in the Roth IRA, it's never taxed again, any of the investments and any withdrawals that I make, and critically, any withdrawals that your heirs make as well when they receive the Roth IRA. They are actually allowed another 10 years that they can keep those assets in the Roth IRA that you pass to them, compounding tax-free. And put some more numbers behind it to make it make more sense. Let's say you get $2 million in the Roth IRA and you're 70 years old. Well, if you can compound at 12%, and ideally if you're pursuing higher octane, private, illiquid investments in your Roth IRA, because that's probably where you want to do it, compounding at 12% is 3xing your money every 10 years. So let's say you've gotten $2 million in your Roth IRA by age 70, and you're going to live till 100 years old. So by 80, that $2 million has grown to $6 million. At 90, it's grown to $18 million. And then at 100, it would be $54 million. But wait, if you're passing that to your kids, they get another 10 years. So let's say you kept it in the same sort of investment that is compounding at 12%, that $54 million turn into $162 million. And this all sounds crazy, but that's just the math. Then when your kids go to withdraw that $162 million, they're not even taxed on it because it's a withdrawal from a Roth IRA. So in order to execute on this strategy, all you need are assets in retirement accounts like IRAs, 401ks, cash balance plans, and the like. And then you also need to have assets in your taxable brokerage account. If you work with someone that has access and knows how to use these tax-aware hedge funds, you would slot those into into your brokerage account, and that's going to open up the possibility for you to do tax-sheltered, tax-free Roth conversions. And what's amazing is you can initiate one of these investments in a tax-aware hedge fund for as little as $250,000. And on average, you would expect around 30% of your investment's value in the form of an ordinary loss, which you could take against your ordinary income. So even if you started at the smallest amount, let's say you invested $250,000 in a tax-aware hedge fund, you would expect somewhere around $75,000 in an ordinary loss or deduction that you could take. But the size of the deduction simply scales up with the size of the investment that you can make. So the larger your capital base, the larger the deductions are that you'd be able to create. Okay, now I'm going to walk through in greater detail a specific example of a client we're doing this for. But before I do, I want to be completely transparent about something. To be eligible to invest in a strategy like this, you have to be something called a QP, which means you have a $5 million net worth excluding your primary residence. It's also going to require access through a financial advisor that has these relationships, and it's not something that you could just do on your own individually. At QFS, we typically work with families who have at least $5 million or more in investable assets, and this Roth conversion strategy is just one piece of our comprehensive tax-aware wealth management approach. We have the institutional relationships to access the correct hedge funds, the expertise to determine the sizing and timing for your unique situation, and the scale to make these strategies cost-effective for our clients. So if you're in that category and this is something you'd like to explore for your specific situation, definitely reach out after this video. But let me show you how this works exactly for one of our clients. Okay, so this client has a net worth of around 15 million, and they've got a nice mix of assets in their taxable brokerage account, and then they also have $3 million in their own IRA. They have a couple sources of income in addition to Social Security and already hitting RMD age. So all in, they're looking at around $200,000 of income before we do any sort of Roth conversion. So as someone that's filing their taxes as single, $200,000 of income has already put you at the 32% marginal federal tax bracket. Now, this is probably a good example of someone where I was mentioning earlier, if you're high net worth, it's nearly impossible to make Roth conversions to make the math work, because any additional conversions you're doing, you're now stacking at the 32% tax bracket, and you're going to go up even higher. And I haven't even factored in the about $5 million that they have in a taxable brokerage account. For your typical advisor, what they'd be doing with that $5 million brokerage account, I guarantee you they'd be recognizing at least $200,000 a year from just interest income, capital gains, short and long term, because of the strategies that they're investing in. So when you would look at filing the tax return, this person's income would be $400,000 a year, making Roth conversions just impossible. Or, I mean, they're not impossible. You could do them, but it would be the dumbest thing you could possibly do because you're going to be paying at the highest marginal tax bracket. It would make more sense to just defer it and not pay the taxes. Okay, so the way that we approach it is step number one for everyone: stop making taxes with the investments in your taxable brokerage account. So I'm being generous when I say that based on the portfolios that I review that people bring to me, a $5 million account and a taxable brokerage account, let's say on average it'd be around $200,000 of recognized income and gains per year. What I do is I bring that to zero. And I don't bring that to zero by not investing and not making money. It's just by doing it in the most tax efficient way you can by using the latest strategies that are available. And so already right off the bat, we've got a huge tax savings. So already right off the bat, we've got a huge swing in growth of the portfolio because we're not leaking out money to taxes every single year. Now, critically too, what that does is instead of $400,000 in earned income per year on average for this individual, we've cut that down to $200,000, which is good, but still not great. What we've done is we've been able to invest in tax-aware hedge funds. And for this year, it'll be about $300,000 in an ordinary deduction. They take that against the $200,000. And what they're left with is it looks like they lost $100,000 net on the year, which opens up Roth conversions beautifully. So what we could do is we could convert $100,000 $100,000, their AGI would look like it's zero because they would net out the $100,000 left in these excess business losses that they would have, and the $100,000 of income that we create, they net to zero. Or what might make more sense, what we're gonna do is we're gonna actually convert more than 100,000 and start working into these 10% and 12% tax brackets, because the arbitrage opportunity there, I'm fine paying 12%, but what I don't want to do is pay any income taxes over 24%, certainly not in the 30% plus tax brackets. And so the glide path that we're on for them is every single year, the deduction is going to get bigger because we're able to add a little bit more to the tax-aware hedge fund. And then critically, and I haven't mentioned this yet, the tax-aware hedge fund is expected to make money. Let's say you invested $1 million in it. So that first year expectation would be around $300,000 in ordinary losses. Well, if the fund has a 10% return, you now have $1.1 million invested in the hedge fund, and your deductions the next year would be 30% of that value. And so through a combination of expecting the hedge fund to perform positively, and so the allocation growing that way, and we're also going to be able to add a little bit each year, the deductions that they're going to have available will continue to grow each year. That will allow us to do bigger and bigger Roth conversions each year and slowly build up the Roth IRA and slowly bring down the traditional IRA account balance that they have. And so once this starts to click for people, their logical next question is, well, is there a limit to how big of a deduction that I could generate and take against my income? And the answer is sort of. The way it works is the deductions you'd be receiving in your K1 from these tax-aware hedge fund is going to be something called an excess business loss, or EBL. There is an EBL cap, a cap for those filing single and a cap for those filing as a married couple. For this year, for single, it's around $313,000, and for married, it's $626,000. But it's not that any amount over that you can't take. It's just any amount over that. So, I mean, instead of $313,000, let's just say it was $300,000 was the cap, and I had $500,000 in excess business loss as someone that files single. I'll take $300,000 this year, and then the amount above the cap, which is $200,000, is going to get reclassified as a net operating loss, or NOL, and that gets carried forward to next year. Fast forward to the next year, and let's say I again have a $300,000 excess business loss because I'm still invested in the hedge fund, but I also have this $200,000 NOL. NOLs can be used to offset up to 80% of taxable income. So technically speaking, there is always going to be some amount of income that you cannot fully offset with an NOL. That's not the case with an EBL, so it depends on just how large your income is. And when we're talking about the situation that we've been talking about, where it's Roth conversions, we have complete control over the timing and the amount of income we want to make it look like you have. When you have a $3 million IRA, there's an endless amount of combinations we can use over the course of your life, recognizing some income every single year, recognizing a large amount of income in one year and then none the next year. It's completely up to us. That's the beauty of tax planning in these situations, is we have all of the tools we need to optimize for your situation, and we're in the driver's seat. The IRS is not in the driver's seat. That's the biggest thing I've learned about tax planning, is you need to take back control of your money and your assets and use all of the tools and strategies available to you so that you're actually able to keep what's yours. That $3 million in your IRA, you worked to earn the income, you invested and took risk to grow it, it's yours. All that we're doing is trying to keep as much of it as we can so that you can spend it, you can invest it, you can pass it to your kids, you could donate all of it to charity. It doesn't matter. What matters is that it's your money and you want to keep as much of it as possible to do what you want with it instead of just giving it all to the government. Now, what are the risks of this strategy? Well, I would say the risks are just the same as any other investment that you're going to make. It is a true standalone hedge fund exposure. They can come in different flavors, though. You can have multi-strats where they've got 6 different strategies running in one hedge fund, and you can produce a very low volatility profile. Or for some people that have higher risk tolerances, you can increase the leverage and have a higher expected pre-tax return. And for that, you're also going to have additional volatility and variance year to year. I would say that's another perk of this, is that it's not just a single fund. There's tons of different tax-aware hedge funds out there. And so what you can do is, once again, customize it to your unique preferences and goals and risk tolerance. What kind of risk are you willing and able to bear? Well, and then we'll find the right tax or hedge fund for you. There isn't a scenario where even someone with a lower risk tolerance wouldn't benefit from an uncorrelated return stream being added to their portfolio that is going to reduce the overall risk of a portfolio that's invested in traditional assets like stocks and bonds. So you can really think of the taxes as just a cherry on top of an investment strategy or asset class that really does have a place in most people's portfolios. The other thing I would say is if you truly want to optimize your taxes with this, the way that most tax or hedge funds work is in order to avoid the basis being depleted to zero very quickly is they'll actually realize long-term capital gains along the way. And so every year on your K1, you're going to get past some capital gains and some ordinary losses. Well, capital gains are super easy to offset if you have one of these long, short tax loss harvesting SMAs going. And it's funny, some people will go, well, you don't need a long, short tax loss harvesting SMA if you don't have capital gains going on. Well, I'd say I can't think of anyone that doesn't benefit from an ordinary deduction, even if you're not working anymore, because you got to be living off of something. So if you need your portfolio to create income, well, here you go, you have an offset for that. Or if you have retirement accounts like we've been talking about, that's income you haven't recognized yet, but why not go ahead and recognize it and have this offset? Oh, and what do you know? We're also going to have a capital gain that's realized along the way. Perfect for you for your equity exposure to be using some sort of tax loss harvesting strategy so that you can offset that. And then the only thing you'd be left with is an ordinary deduction that you get to take every year. So as you can see, the super duper mega tax-free Roth conversion can be an unbelievably powerful strategy that most financial advisors simply don't have. You need access and you need the knowledge of how to use these things correctly. And that's something that most people simply don't have. And in order to do it correctly, you can't be working with an advisor that has hundreds of client relationships because it requires too much time and attention to detail to your unique situation. It's not a simple plug and play for every single family. It really needs to be dialed in and tweaked to that specific family's scenario. And it's not just their scenario in this current year. What are their goals? So I guess here's an example I didn't give, but if someone does not want to pass any money to their kids or any family members, they want everything to go to charity, there's absolutely no reason why you would do this. What you can do is you can set aside IRA account balances at their death, just have that be donated. And then they can also do qualifying charitable donations from their IRA account to where this isn't even something that it's not worth it for them to be doing something like this. So again, it really depends on what someone's specific scenario is, what their goals are, and you got to be able to find someone that you can work with that understands how to do all of this. So if you're serious about implementing this and you have the capital to make it worthwhile, click the link in the description to book a consultation call where we can talk about your specific situation and see just how much tax savings we could generate. Make sure to subscribe for more videos like this, and I'll see you next time.